be showing you how to actually start your analysis and do all you have to do. So let me read through what I shared today on the group. All right, so as market structure is the driving mechanism of the market. It is the foundation upon which every strategy is built. And this is true because ICT, whatever you're using, you must have market structure. You must know where the market is going, where the market is coming from, before you can do any other thing you want to do. Market structure is very, very essential in trading. So now, how do you how do you start? How do you know what to do? Now, first, you have to understand what market structure is. Market structure is basically where buyers and sellers start buying or selling. That's the most basic term to define market structure. So if buyer starts buying at this point, price move higher. Seller starts selling at this point, price moves lower. Buyer starts here, price moves higher. Seller starts here, price moves lower. So it continues like that. It just shows you where buyer starts and where seller starts. Now, why is it essential to know this information? It is essential because that's how you can tell where you can now start buying from or start selling from. If the last buyers started buying from this level and they stopped here, sellers started buying, tells you that you should start buying from this level as well. That's why if you buy from here, see price goes higher. But I want to explain why this happens in professional terms now. In the market, we have what we will call retail traders and what we will call institutional traders, which are the banks. Retail traders are you and I on this call. We have 10 million, $2 million, $20 million, and we are trading. But institutions are the banks, people with billions of dollars, because the banks trade forex. So these are the institutional traders. Now, in a market, the institutions are the people that push price higher or lower. So bankers push price strongly like this. Why we retail traders we take profits. If we buy good at 4,000 per ounce and gold price rises to 4,150 per ounce, we will sell and take our profits. But because we are retail traders, our position doesn't really make much move in the market. So you just have a pullback, but it's not compared to the move that the banks made. Okay. Now the banks say that we have taken profits, so they push price higher again. We take our profits, pull back. Sometimes our profits can go way as this, sometimes less. Okay, sometimes a bit more. But then the institutions push price higher again. The cycle continues until they decide not to take their own profits. When you take profit, you see that price drops strongly and the trend changes because they have liquidity. Okay, so when they push price like this, everybody buys, they now take their own profit and they sell, and the entire trend changes. Some systems will call this liquidity grab or whatever you want to call it. But this is basically what happens. The banks just takes their profits. So liquidity grab, trend line break, whatever reason, just bank taking their money. Now, this happens for downtrend as well. Happens in both scenarios. They push price lower, people think that that's the end of the day, but then they buy. Okay. So I believe that explains the theory behind the market mechanism, price moving higher or lower. Basically, by banks pushing price higher and British traders taking profits from the market. Now, once you've seen your chart, how do you know where to start from in analyzing the market? I've made it clear earlier that buyers push price higher, and the previous point from which they push price always have buying power. So when banks push price higher now, this last point they were in, there's a possibility that some of their orders did not fill. So when price comes back to that point, those orders fills and price moves higher. So both retail traders and banks, they all join in to push price higher at previous levels. These previous levels that they're not called key levels. Okay, they're called key levels because these are levels that price had major changes. Sometimes it can be at the recent high like this. Banks enter strongly at this point. So when price pull back to the recent high, you see that price reacts to that because some others were not filled and price goes higher. Or price can come down to the POI level. This is where banks enter the market and price reacts to it strongly and price goes up higher. The point remains banks push price strongly while we just profits to create high highs and higher low. Please, we can all mute ourselves so that everybody hears me clearly.
Yes.
Okay. I think everybody is muted now. So I've explained the mechanism behind price movement. If you are just joining, I'll drop a recording of this so you can go through it yourself. Now we established that price moves higher highs or lower lows. Higher highs basically means price is going higher like this, or lower lows means that price is going lower like this. Okay, that's what it means. Lower lows like this. This is a low, price is a lower low, a lower line, previous low, lower high, lower high. If it's opposite, it's higher highs and higher lows. That's a trend. So we call this bank pushing price up and taking profit. Call this a trend. It's an uptrend because even if we take our profits, overall price is going upwards. That's an uptrend. While if they are pushing price down and are taking profits, it's called a downtrend because overall price is going lower. Okay. So I've established uptrend and downtrends. When price moves higher and when price moves lower, it's a downtrend. I believe most people know this already, but it is worth establishing to drive home the whole point of today's meeting. Now, the main thing I'm talking about today is where do you start analyzing from? If you open your chart and you see your market like this, you see a lot of candles. I'm like, what do I do? How do I start? Sometimes you won't forget how you even trade or your strategy. I'll be giving you guidelines on what to do. The first thing is to zoom out. Now you're seeing the candle, the color of the candles like this. So you want to zoom out carefully until also I almost forgot. If you're analyzing, make sure you're using a laptop, please. Or yes, a laptop is more important, is more better than using a phone. Okay, use a laptop and get the mouse. It saves you a lot of stress and makes things easier for you. You use your mouse, just roll until you see that it's now clustered like this. You can no longer see the candles individually. It's now clustered like this. This is when you now start your analysis. So now once you've done it, you now look for the most recent high and most recent low. Here's the most recent high, the highest high. I call this peak. This is now your peak. Now, your low, the lowest low possible. I can call this your low. Okay? I hope this is clear. Now, I've talked about I shape, B, and A shape on the group. Now, your I shape is basically when price moving up like this in a straight line like this. This is an I shape. But now, when price, let me know something else. So from this point, from this low to this point, you can call it an I wave because price is moving higher. It's an I wave. So if you open your chart and you see just price moving in one direction over time, you know that it's an I wave. So you just look for a most recent key level. I'll explain that shortly. But this is an I wave. Now, if it's a downtrend, price moving lower like this, just straight. Forget about what we are saying after this line. Forget about this level. Just focus on from here to this point. This is an I wave as well, but it's a downtrend. It's a bearish I wave. Okay. Now, we'll talk about V wave. I'm sorry, A wave is when price has move from just being straight and it has now created a down move like this. It's now an A shape. It looks like an A. This means that price is trying to change trend from an up to a down trend. Okay? Now, if it's upside down like this, you see that it's a V wave. Price moves down strongly, but this is happening. It means that price wants to change trend. So now it's no longer just an arrow, it's now a V wave. But if it's a downtrend, an option, sorry, it's now an A wave. For example, I want to show you a previous price movement. If you see this previous movement, now before price broke, before price went higher like this was a V wave, but price went higher. So no longer a V wave, it's now an I wave. So I wave changes to V wave changes to A wave. It's just an entire sequence. So it has broken it, broke it like this. So V wave has changed to an I wave now because price have gone above the previous high. So when you open your chart, look at it clearly. If price is just moving up straightly, then you know it's an I wave. But like this now, we have a V shape. But we won't just conclude that it's just what we are seeing. We have to now step in lower to be sure if it's actually price actually changed trend or not. But rising from this low to this peak, I hope I have not lost you guys. Rising from this low to this peak, because when you zoom out, this is the lowest low and this is the highest high. So now, like I explained before, uptrend, higher high like this. We'll do it on the chart now. So starting from here, simple. Okay. Now, when you see different lows clustered like this together, don't try to analyze it because it's just the same thing. Don't try to look at it like this. It's all the same thing. So just start from the most recent one to go higher. Okay. Please, everybody should mute themselves. I'm having some interference right here.
Oh, season.
All right. Now, like I said, if you have different lows clustered together, make sure you just stick to the most recent one. So you start from the most recent one to analyze from here. This cluster does not really matter. Okay. Now, tomorrow I will drop standards of marking this pullback and breakout because it's not just let me just draw because I'm seeing up and down like this on the market. No, the standards you follow, and it's very, very important. If you miss any particular standard, you've missed the entire analysis and you'll be having wrong results. Okay, so I'll drop the standards tomorrow for you. But let's just work with what we have right now. Now you have seen that this is an uptrend. If you check on this now, you see that there is no valid after price created broke this high like this now. There's no valid pullback in 4-hour time frame. There's no valid pullback here. I will explain what valid and invalid pullback is tomorrow. But as it is now, this is a recent high, this is recent low. This is what happened. So this V wave they're trying to form now is invalid because price did not go below this level. So we are still on a straight I wave. You understand? When you are initially analyzing, you can just assume, okay, maybe it's an A shape. But when you zoom in and analyze, you now say, okay, maybe it's not correct. We are still on an I shape. We are still bullish. We are still just moving in one direction. Until price change before it can now change to a downtrend. And the price takes the most recent low in an uptrend like this now. If price doesn't go below this previous low, price is still in an uptrend. Until price goes below it like this, it has changed to a downtrend. But if price is still here, it's still in an uptrend. This is the case here. Price is still above the recent low. That's number two. So you'll be looking for buy positions in this market at the moment, not sell positions because price is still bullish. I hope you are getting me. So I think I've explained A and V shapes already. The meeting might end very soon, so I will send on that link once it ends. So we continue. Now I've explained I and V shape. I hope you all understand. If you don't understand, just mute if I ask your question right now before we proceed. Unmute, ask questions if you don't understand. Okay, I can assume that everybody understands.
I don't understand.
You what don't understand?
I came late, so I missed where you talked about the difference between I shape, V shape, and A shape.
Okay, this will happen. We already have limited time. So it's being recorded. So once we are done, I will drop the recording of when I explain that so you can go through it. But you are still very early. So what we'll be talking about.
Alright, thank
Right. Who else has a question? Okay. No other question. Right, so I'll assume everybody has gotten I and V shape. Let me say verbally again. I shape is when price is moving in just one direction. When you zoom out, you see just one direction in the market. There's no complication, just one straight line in the market is an I shape, straight line like this. But when you are seeing curves like we are seeing in the market like this now, it's not an A shape, or you're seeing curves the other way. You're seeing curves when it's on a downtrend. It's a V shape like this, the V shape. That's something I and V shape. And to determine if you have an I or V shape, you have to first zoom out your chart so you see the candles. Then you zoom out onto your clusters like this. Then you look to see what you have. Then you can start analyzing. Okay. Now, I've explained higher highs, higher lows. I've explained I and V shape. The next thing I'm talking about today is your time frames. Okay. Time frames are very, very important because if you just open a chance, you want to trade 5 minutes time frame, you hit so many stop loss, you blow your accounts, you quit trading. You can't trade only one time frame in the market. Okay, just like I explained on the group, like you're in a city. If you just start from the street you're in, we are looking for someone's house, and you don't know the street you're in, you have a long way to because you are lost basically. You're in a city, you don't know the person's house, you don't know the street, you don't know the city, you don't know anything. Yeah, you are lost. So you need to first find out which city you are in, which street you are in, then before you cannot find a person's house. That's actually needs. You need to first find out what's most important. You can't analyze from 5 minutes time frame or 15 minutes time frame. You start from high to low. So you get the full picture of what is going on. The market itself is fractal. What's happening in 5 minutes is happening in 1 hour, happening in 4 hours. This opening like this now happens in 1 hour, it happens in all the time frames, in all time frames. But you need to classify them to know which to start from and which to follow up with. If you watch what I'm doing, this is 4 hour time frame. When I said you should zoom out until you count the clusters, it's 4 hour time frame. I didn't say 5 minutes time frame because this is the essence of 4 hour time frame to find the trend. That's the essence. 4 hour time frame is where you will zoom out to see if it's an A or a V shape, to see if market is trending or not. That's the essence of 4 hour time frame. Now, once you want to leave 4 hour time frame, next time frame is the 1 hour time frame. That's where you begin your analysis. I hope you are getting it. 4 hour is for your trend or knowing direction of the market and all that. 1 hour, where do your analysis, market structure and everything. Then 15 minutes, where you enter positions. This is how we break it down. 4 hour trend, 1 hour market structure, 15 minutes for entries. So I was very fast in everything I said. So in the next um, session, that's 30 minutes, I will take questions and I will go through everything I've said again because I finished fast. I finished early today. So in 2 minutes, this session will end, and we have to wait for 10 minutes to generate on that link, and I'll send it to you, and we'll go through everything again. But once you've gotten your 4 hour, once you're not sure of the trend that you're in, I could establish on good. We will establish that we are in a bullish trend like this. Next thing you do is to find your motivation key level. Your key level is the most important level because that's where institutions, banks stepped in to push price higher. So you mark out your key level in a 4 hour time frame. I can label it your 4 hour up, because it's a bullish key level. Okay. Now, from this 4 hour now, you have gotten your 4 hour trend and everything. Next thing you do now is to find your 1 hour. But before that, after marking your 4 hour up, you also have 4 hour down, because this now, at this point, price started dropping. This means that at this level, banks push price lower. So this is a key level as well. It's an important level. So you can now mark it as 4 hour down. Okay. Now, multiple time frame analysis teaches us that 1 hour begins from 4 hours. So from this point now is where your 1 hour begins. Here's where 1 hour begins. If you mark from this point now like this, go to 1 hour time frame, you get your 1 hour trend from here. Here, 1 hour is just one straight trend. There's no structure in 1 hour here. Same as this other side. Get a 1 hour trend from beginning of 4 hours. I think this is just one trend as well. No valid pullback. Remember, I'll explain valid pullback tomorrow. Okay. So 4 hour for your trend, 1 hour for your market structure, 15 minutes for your entries. I would execute trades with you here and we'll get everything live. So I think this is the best. This is the best you get from me in this 3 days bootcamp. I will explain everything I do, how I do it, all of it. So just stick with me. I'll send the new link shortly.